Well, good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Friday. It's the last trading day. Yeah, it is the last trading day of February. The market took a nice little beatdown yesterday, as you will see right here. We're in this 50-day moving average breakthrough, and the question is, are we going to break it down and head to the 200-day moving average, which is, let me just kind of put that on here so you guys get some perspective. And that's the 200-day moving average. I should probably change the color of this chart. It's, otherwise, let's see here. Let's make this one green. How about that? There we go. So that's the 50-day moving average. That's the 200-day moving average. And it looks like we're sitting right at the 50-day moving average. And it looks like there's a good chance we may break it down. Now, I'll get into that in a second. The big report for today is personal income and expenses. Now, as you can see here, the range is literally all over the place, but we are expecting it to come out at 9.4%, which is a surge from January, thanks to the federal stimulus payments that we received a few months back. Now, in terms of inflation, which is the biggest factor, we want to look at the core PCE. The core PCE measures the personal consumption spending, or personal consumption expenditures, if you want to be specific. And right now, the numbers are not really, they're kind of in the middle of the range. They're not really seeing anything major. So right now, in terms of the economy, inflation is not really there. But in terms of the bond market, man, look at this. And finally, after all of this sell-off, we finally look like we're bouncing. After RSI went all the way down to 11, it looks like we were closed at the top, and it looks like today we're going to be opening a little higher. So expect bond yields to drop and bond prices to go higher and interest rates to go lower. Remember, there's an inverse relationship between bond prices and interest rates. Bond prices and interest rates. If bonds go down, interest rates go up. If interest rates go down, bonds go up. So there's a negative inverse relationship. So right now, with interest rates, with bond prices moving a little higher, or it's expected to move a little higher, there's a good chance that interest rates will fall a little bit, and that'll decrease the chances of inflationary pressure just a bit. But again, the federal government does not want to raise rates. They don't want to lower rates. They want to leave things alone. But I do believe we're going to see a bounce with the long bond. If you're trading the TLT or the futures, I think we're going to see a move from the 138, 140 level to about the 150 level, and then I think we're going to drop again. But I think we're going to get a little retrieve here, or a little pullback. Now, here's something interesting for you. We've had two reports yesterday. We had GDP and jobless claims. Both reports were actually positive. That's right. We saw jobless claim numbers. Look at this, 730. Finally, they're making their way down. We were expecting 815. We got 730,000 new claims, better than 815,000, and a lot better than 900,000. So the number was positive. Then we had the GDP, and the GDP was positive, and the market went down. So it's not, look at that, 4.1%, right on consensus. So it's a little shaky, because when markets go down on good news, that's a little troublesome. But I've been warning you that momentum levels are about as overbought as they can possibly humanly get. Now, let's talk about the news, and then I'll get into some technicals. U.S. futures turned higher this morning after a rout in technology companies pulled the Nasdaq down 3.5% lower in the steepest loss since October. The sell-off Thursday on Wall Street picked up speed when the yield on the U.S. Treasury note exceeded 1.5%. Remember, yield goes higher as bond prices go lower. Level not seen in more than a year, and far above the 0.92 that it was trading only 2 months ago. This is 2 months ago. This is when it was at 92, and this is 1.5. So again, remember, as this goes down, bond yields go higher. So there's an inverse relationship. So just wanted to show that to you. The recent rise in bond yields reflects growing confidence that the economy is on the path to recovery, but expectation that inflation is headed higher, which might prompt central banks to raise interest rates to cool price hikes. Federal Reserve, Jerome Powell, he's sticking to his guns. God bless him. He affirmed the Fed's commitment to keep low rates low, to keep to low interest rates, not to keep low rates low. The problem is, if he keeps the short-term rates low, and if the long-term rates start heading higher, that's not good either. That's a sign of inflationary pressure. Expectations for strong growth were reinforced by news that U.S. economy grew at an annual pace of 4.1%. That's what I just talked about, the GDP right here. That's this report here. Again, I just want to give you some context. That's why I'm going back and forth. Context. That's why I'm going back and forth. That it grew 4.1% in the first 3 months of 2020, slightly faster than anticipated. Higher government spending, accelerated vaccine distribution could lift growth in the current quarter, ending in March to 5% or even higher, economists believe. That is very, very positive. Now, futures are up. As you can see here, the Nasdaq's up about 54 points. The Dow's down. We're kind of all over the place. Now, in terms of price action, the Nasdaq is really taking it down. And my hope is that we're going to trade above the 324 level. If we trade above the 324 level, 325 level, there's a good chance we'll go higher. If we break the 310 level, it's bad. Now, if you look at the SPY, the S&P 500, you will see that it's still trading above the 50-day moving average. So if we bounce from these levels, it will be very, very positive. My problem with all of this is, if you look at the S&P, first of all, if you look at any stock right now that's trading above $2 and you look at the number of stocks above the 200-day moving average, the number's a little concerning. Let me just make it easier for you to see this. Look at where we're at right now. This is a weekly this is weekly 5-year. Look at where momentum levels are. Do you see a higher level in 5 years? 90th percentile right now. That's the number of stocks trading above the 200-day moving average. Now, let's go 10 years. Do you see us trading above this level 10 years? We are at the highest momentum levels in 10 years, folks. 20 years? Well, here we go. We have been to this level. We were at this level about March, let's see here, summer of 2009. And let's see here. And we were also at this level January 2004. So in the last 16, or let's see here, in the last 18 years, this is how far this goes, or 20 years. This starts in May 2001, and this is now. In 20 years, this is 20 years. We've only seen momentum levels on the S&P 2 times at these levels. So right here and right here. And what happens both times? First time it went to 41%, and second time it went to 43%. Now let me show you what that would represent on the stock market, on the index. Just to give you a perspective. If we went to the 40th percentile, that means we would go right around here, right to the 349 level. So that's the question. Are we going to go there or not? That's the big question. I don't think we're going to go there right now. I think we're going to bounce a little bit for the next day or two, but I'm very, very nervous about the momentum levels. And they're not just that high on the S&P. They're that high on the Nasdaq as well. And they're that high on the broad market. Now, in terms of sectors, as you can see here, technology and consumer discretionary, they're no longer leading anymore. You've got energy, financial, industrial, and basic material leading. Now, if you look at these sectors, I want to show you something interesting. Look at the energy, though. If you look at a 2-year chart, it's just now starting to take out the high, or it's starting to fill the gap that we had here when we broke down last year, right around March. But if you look here around February, we still haven't reached that February level. So I'm still a little cautious on energy sector. And if you look at the financial sector, you will see that we are finally above that level right here. So I'm bullish on financials now, but I'm not bullish on energy just yet. And if interest rates go up, it should be bullish for the financial sector. In terms of other sectors I like basic materials, I like industrial. Not really that bullish on anything else right now. I wouldn't be going long on tech. I would wait for a pullback and a confirmation. But again, technology and consumer discretionary is not where the money is. The money right now is moving into energy, financial, industrial, and basic materials. Now, let's look at the S&P 500 and let's see if there's some new stocks on the horizon. Hey, Discovery. Do you remember the stock that I told you guys would be the #1 stock? Discovery? Guess what? Discovery's there. Kohl's, Viacom. I told you the stock was going to rally about 2 weeks ago. It's rallying. So let's see, new stocks on our list that we don't recognize, MRO. This is a new stock on our list, on our S&P 500 scan list. It's gone up substantially, MRO. If you look, let's go 2 weeks ago or a month ago. Do you see MRO anywhere here? I don't see MRO. Let's go to today, and let's go back a week ago. Do we see MRO? Nope, not seeing it. So let's go to today, and you could see MRO it's gone up substantially on this list. The stock has gone up 38% over the last month. Wow. So here are the stocks that I like here, but there's really nothing new here. I'm just trying to see Discovery I've been talking about. Viacom was a new one, and it's still up here, and it's still moving higher. This is an old one. This one, MRO. And again, Freeport McMoran still on there, and I've been talking about the stock quite a bit. Otherwise, let's see here. Am I seeing anything really new here? I'm seeing clothing stores, retail kind of fall off the wagon, and I'm seeing other stocks, but these stocks were also up here. But right now, the key is this. You don't want to be in tech right now, and you don't want to be in consumer staples. My advice is stay with financial, industrial, and basic material stocks. So, and again, the only new stock that I'm seeing here, otherwise, all the stocks that I've been calling for are actually higher. Discovery's number one now. Viacom. Let's see where Viacom was a month ago. Let's see if we could find Viacom. Viacom was 1, 2, 3, 4, 5, 6, 7, 8th place. Viacom is now 3rd place. Now let's look at the Nasdaq 100 before we conclude. Again, the new stock on the list is MRO and Nasdaq 100. I always like to see what stocks are making new highs on this list. Baidu, Tesla, nothing new there. Western Digital is going higher for sure, for sure. And again, you have a bunch of tech, but finally, look at this. Marriott, Ulta Beauty, tech chips are falling off. This was all chips about a month ago. KLAC, semiconductors. Now we're seeing other stocks like Expedia. I like this. Marriott, Ulta Beauty. Ulta Beauty hasn't been on the top scan since before the pullback. Illumina. So Illumina is a new one. Ulta's a new one. Marriott's a new one. Expedia's a new one. If I were you, I would be focused on these stocks in the Nasdaq right now. Expedia, Marriott, Ulta Beauty. I think they're going to go higher, and these are all stocks that thrive in a not in a stay-at-home environment, but in the going-out environment. Expedia, travel plans. Marriott, hotels. Ulta Beauty products, going out. So this is giving us a very strong indication that stay-at-home stocks are no longer leading, that we've got a lot of going-out stocks leading. Look at this. Expedia, Marriott, Ulta, beauty supplies. People need beauty supplies when they go out. People need Marriott when they're traveling. And people need Expedia when they're making plans. And these three stocks, let me show you. I want to show you this a week ago. See, a week ago, Ulta was here. Let's see here. Ulta was here. Expedia was here. Okay. But I'm not seeing the third one. But the bottom line is, let's go a month ago. Let's see here. Let's see. Do we have Expedia's here? Let's see here. Alta's here, but a little lower, and the other one is not. So again, the ones that I like are Marriott. That's totally new on this list now. Marriott, Ulta, and Trip. Look at Trip.com. Let's look at some of these, okay? I like these. I like this. This is good. How big of a difference a year can make? Look at this. Look at that. Mars breaking out. Trip. Let's look at Trip. Where's that Trip? Come on, Trip. Where's Trip? I just had it here a second ago. Huh. Let's look at Trip. Look at that. Again, where was that stock? I thought I just had it here. Maybe I'm losing my mind. It wouldn't be the first time. Interesting. Very, very interesting. Oh, this is February 25th. Yeah, that's... all right, let's go 1 week ago. Do we have Trip here? Oh, well, maybe I was hallucinating or something. I don't know. But anyway, the bottom line is you could see here, TripAdvisor stock. Look at this. And if you look at it 2 years, look at the breakdown that we had in that's when it broke down right here. But yeah, I like Trip stock. I like Marriott stock. I like these travel stocks. This is very good. As a matter of fact, Expedia as well. Let's look at Expedia. EXPE. EXPE. Yeah, starting to make a comeback. Folks, stay-at-home stocks are no longer it. Going out stocks are starting to make a comeback, as you could see here. And as far as the S&P 500, the number one stock here was, that was the Nasdaq I just went through. But as far as the S&P, the stock that hasn't been on my list was MRO. Let's look at that one. I want to be thorough for you guys today. Starting to make a comeback. But again, I would wait for the stock to trade above these levels. This stock's got more upside to go. But again, Marriott, Trip, what was the other ones? Let's see here. Let's organize this again. Expedia, Marriott, Ulta, and Trip. There it is. Trip.com, TCOM. Let me put that on here. TCOM, that's it. I thought it was Trip. There's two Trips. There's TCOM, and then there's Trip. You see what I mean? That's what got me confused. But they're both doing exactly the same thing. So this company, Trip, they do data processing, online travel research. Okay, so it's a travel company. And the other one, let's see here. One-stop travel. They're both travel services. That's why they're both doing exactly the same thing. Now, folks, before I let you go, I've just pulled back the curtain on a handful of small cap stocks and I believe are poised for massive breakouts. You got to understand something. Trillions of dollars are now being poured into once overlooked small cap sector, but it's not overlooked right now. And if investors can identify exactly where the money's about to flow next, they can literally collect massive windfalls on these stocks as they rise. In just a matter of 1 week, I signaled 118% return on PFSI, 153% return on DDD, that's a 3D printer company, and 414% on CNE. It happened February 2nd, all in 1 week, just beginning of this month. Now, this is just the start of my new strategy because finding these, what I call microbursts, happens to be my specialty. Click the link to reveal my secret head of the next big market move. Make sure to like this video and subscribe to this channel if you're watching on YouTube, and stay ahead of the market by being the first to subscribe and be notified when we post new videos. And again, click the link to reveal my secret head of the next big market move. You've got to check this out. I'll talk to you guys later. Don't miss out and have a great week. Bye, guys.